Oil prices. We've talked about oil many times on the show, and for the most part, they've been range bound in and around $70 a barrel. And even though we've seen the Saudis cut their oil production, we've heard that the Russians have cut their oil production by 500,000 barrels per day. The Saudis, 1 million barrels per day, and those cuts are going to be kept heading into August. And that didn't even move the oil market or the price per barrel of oil. So what does move oil prices? Well, I think we're starting to see what moves oil prices right now. WTI now is above $75. It's taken a bit of a jump. And why is that? China. We're now hearing that China is starting to import more and more oil. We're starting to hear that the growth story in China is getting better. We're starting to see more and more Chinese traveling around the world once again, spending money. This, in my opinion, is an indication that their economy is getting back on solid footing. For quite a while there, Chinese economy was in a bit of a lull. They were growing, but not at the rates we're used to seeing. And that has helped, most definitely, keep the price of oil down, because China, as we know, is the largest importer of oil in the world. So if China is importing less oil, that means there's less oil in the world. Sorry, importing less oil, that means there's more oil in the world to go around to all the other nations, all the other countries. But when China is pulling in, I don't know, 15 million barrels or whatever it is per day of oil, that is a sign that things are rebounding in China. And that is a sign that price of oil is going to start to tick higher. And many believe that we will see oil in that $85 range in the not so distant future. What does that mean for perhaps inflation, the Fed, and interest rates? Well, if we do see oil tick higher, it is a bit of a lagging, it will have a bit of a lagging effect, but I think you could see inflation tick higher. What does that mean for interest rates? Well, if the Fed is just looking purely at the rate, the headline rate, maybe they talk about raising interest rates once again. Maybe the Bank of Canada continues to raise interest rates, because inflation is driven a lot by energy costs and oil. So overall, we have a picture, or a graph, I should say, of the price of oil. You can see how much the price of oil has fallen, but as you can see here, bottom right-hand corner, it is now ticked higher. And I can tell you today, price of oil is above $75 per barrel WTI. So that's the US measurement for the price per barrel. Brent, which is Europe pricing, is well above that as well. So keep an eye on oil prices. Keep an eye on what China says. I believe it's going to go a long way in terms of how inflation might react. It's going to go a long way as to what we can do to mitigate or keep prices of oil down. And one of the ways, and probably the biggest way, or the reason why price of oil is down, is our second chart here, is oil production out of the United States. And we see here, the United States produces almost 13 million barrels per day of oil. By far and away, the biggest producer. The Saudis now, I think, are under 10 million. The Russians now, I think, are less than that as well. So the United States, most dominant player in terms of oil production. And the main reason, in my opinion, why oil has remained in around $70. But now, if the United States cannot or can't really increase much more, maybe they can get to 13, 14 million. And if the Chinese and Chinese economy starts to roar again, and the Asian economy starts to roar, we could see oil prices, as many people predict, above 80, maybe 85, 87, in that range. So let's keep an eye on oil. Let's keep an eye on the Chinese economy. And obviously, we'll have to keep an eye on inflation to see if there's an effect that oil will have going forward on inflation.